What's up, everyone, and welcome to the School of Personal Finance. So this is the third video of the Master Your Family's Finances video series. In the first video, I walked you through how to complete your cash flow statement. In the second video last week, I walked you through how to complete your net worth statement. And now in this week's video, I'm going to walk you through how you take those two financial statements and you start analyzing your current situation so that you can make some decisions going forward on what you should be doing next. So let's get to it. The first thing that I'm going to look at is right to the bottom of the cash flow statement. And that's how much their net income is compared to their monthly expenses. Now with that monthly expense number, it does include things like investments, like the kids' college 529 plan and the money that's going into the emergency fund. So the first thing that I'll do in my head is just back out those investments to see how much it does actually cost for them to live each and every month. So if we take out that $400 there down at the bottom, we see that it's basically $6,500 for their monthly expenses. Now, we could get lost in the weeds here. There's so many different ways that we could slice and dice these statements. Like, for example, if we look to the left where their income is, there is $300 that's being deducted pre-tax for medical expenses. So that is a real monthly expense. It just happens to come out of the paycheck before taxes. So we could add that back in if we want to, but with all this stuff, knowledge is power. So don't get caught up in the little details and making sure that everything's exact and perfect. It's okay to be off a little bit. It's okay to guesstimate. Just by looking at this stuff and knowing where you are, it will help you so much. So don't get bogged down in the smallest little details of everything. So for this, I'm just going to say to myself, all right, it costs them about $6,500 to live every month. So then the next thing that I'm going to do is I'm going to jump over to the net worth statement. And I'm going to see how much cash they have on hand. How much do they have in savings, in an emergency fund? If something were to happen, what is their financial position when it comes to their cash? So for these two, they have $4,000 in an emergency fund. So at least they have some cash, but it's nowhere near what it needs to be. So I'm going to keep that in the back of my mind as we keep on looking through everything. But they need to build up that emergency fund. It's good that there's some money in there, but it's definitely not enough. And while I'm over here, I'm just going to glance through the assets just to put a number in my head to see how much they're saving for retirement, if they're sitting on any investments that are non-retirement related, like a regular brokerage account that would be accessible right now as opposed to 59.5. So in their case, they have $230,000 that save for retirement between the 401k plans and the Roth IRA. So that's a pretty good number considering that they're in their early 30s. And then they have $20,000 that save in the 529 plan. So they've done a decent job saving money for retirement and for their kids' college education. Next thing I'm going to do is I'm going to quickly look over at the right-hand side and go down their liabilities. So the mortgage, $300,000, the HELOC, $60,000. So if we compare real quick, they owe $360,000 on a $400,000 house. So that's a 90% loan to value ratio, right? The house is worth $400,000, 90% of that would be $360,000. So they're highly leveraged in their home. So I know right off the bat that HELOC at 5.25%, I'd like to get rid of that. It might not be enemy number one, but I'm already putting it on the list. That's something that we need to attack. I'd much rather just owe the $300,000 on the mortgage as opposed to owing $360,000 between those two loans. And the mortgage is fixed at 4.5%, where the HELOC, those are variable rates. Home equity lines of credit have variable rates. So as interest rates go up, the rate on that and the payment on that will also go up. So keep that in the back of our minds here. The student loans, so there are two student loans, $70,000 between the two. Now, yes, it's great that they got their college educations, that they're earning more money because of that they have good solid jobs because of that, but we don't want that debt. So we know that we want to get rid of that also. And then we see the Chase credit card, 19%, $15,000. We don't need to look any further. We know that thing, we got to get rid of it at all costs. So no matter what we need to do, that Chase credit card, that is enemy number one, and we're coming after it. So after looking at these two, we can make the assumptions that they're good at saving for retirement. There's not a ton of stuff going on. It's not like their liabilities list is 20 items long, but they do have big balances on those liabilities. So it's laid out in front of us. It's clear as to what we need to attack. So now we're going to go back over and we're going to look at the cash flow statement again. So the next thing I like to look at is at the cash flow statement is if we were to stop investing altogether, how much money would that free up? So if we look at, there's the Kids 529 plan at the bottom of the monthly expenses. There's the emergency fund, which is $200. That's $400 right there. And then with the 401k, they're currently contributing $900 a month. So now they get a tax deduction by doing that. So if they were to stop doing that, that $900 a month, they would probably only see a little bit more than $600 of that back. So I'm just going to make the numbers easy and say that if they stop contributing to their 401k, that would increase their monthly cash flow by about $600 a month. Now, I'm not saying that I'm going to recommend that they do that, but I just want to know if we were to stop these investments and savings, how much money would that free up if we wanted to take it all and start attacking the debt with it? So in this case, we figure it would be about $1,000 a month that we could free up by stopping all the investments and savings. The next thing that I'm going to look at is for their mortgage. How much of their income do they currently use for their mortgage? So now this mortgage payment, it includes their property taxes, and it also includes that home equity line of credit payment that they have on there. It's not listed on this expense sheet, and it should be. So I believe that the HELOC payment was $400 a month, but that's included inside of that $2,500. So if we quickly do the calculation, how much of their gross income is going towards the mortgage? And that comes out to 22%. That would be the $2,500 divided by the $11,500 of gross income that they make. And then for their net income, so for their net income, they take home $7,000 a month. So 36% of their net income is going towards paying their mortgage. And now after doing this, thousands of times with people, those numbers really aren't that bad. So I've seen people that, spend much more on their monthly housing expenses than 22% of their gross income. So that's not like a huge red flag. I mean, yeah, it's a big monthly amount, but it's not a huge red flag. Next place my eyes are going are to the monthly expenses. I want to highlight all of the bad debts, add them up, see what we're looking at. So just starting at the top and going to the bottom, the 2 car leases, $750 for the 2 cars. We would love to get rid of that stuff. I mean, those are big car payments, to lease cars. So that means when the lease is over, they're going to have to renew again. If they don't have anything at the end of those leases, they're going to have to put more money down and start these payments over once again. We don't want to get into that cycle. So we're definitely going to have a conversation about the car leases and see what's going to be the best option for them going forward. The student loans, that's $650 between the 2 student loans. We want to attack those things. Those things are definitely on the radar for the debt snowball for us to, get rid of those things. The term life insurance, cell phone, cable, car insurance, homeowners insurance, those things, maybe we could negotiate better rates. Maybe we could shop them around a little bit, but those are expenses that, are not going away unless they're planning on, cutting the cord and getting just Hulu and Netflix or something along those lines. But for now, we're just going to leave those be. Maybe we'll put a little asterisk next to them for things that it's worth a phone call, where, it's definitely worth a phone call every once in a while to your cable company and be like, paying way too much. Is there anything that you could do for me? Or I'm going to, jump ship and see if you could get better rates. So we'll put an asterisk next to those, but those aren't going to be included in our debt snowball. And then we go down to the variable expenses. The big highlight is that credit card minimum payment, $200 a month. That's where everything's going right off the bat. That's what we need to get rid of first. And then as far as groceries, eating out, electricity, those things are here to stay. Like maybe there's some wiggle room, maybe there's some things we could do. If we're in a dire situation, eating out, entertainment, we eliminate that altogether. If we want to, be stuck in our house all the time, which nobody does. Groceries, $500 a month for a family of 4. Very realistic. I don't know how much of that you could really cut out. I have a family of 5. We spend more than that on groceries. So altogether, I would look at this and I wouldn't be like, oh my God, you guys are in such a terrible situation. It's like we need to change everything and we need to do it right now. That's not the conversation I would be having. It would be more along the lines of, listen, we could do a lot better than what we're currently doing. We could get rid of all this debt, free up, a few $1,000s a month for you. Then you could really start saving and investing and, living a little bit more, a little bit of a stress-free type of life going forward. So you might ask, well, where are we going to get the extra money to start paying these things off. So in this situation, I would no doubt recommend that they stop contributing to the 529 plan and to the emergency fund. So that's $400 right off the bat that we would turn around and start paying directly to that credit card. Then the next thing that I would recommend that they do is for the 401k contributions. So for both of them, I would go and find out exactly how much they get in an employer match. I would take full advantage of the match for both of them. So I would contribute up to the amount that they're taking full advantage of the match, and then anything above that I would stop. And I would go ahead and put that towards that credit card until that credit card is in fact paid off. And then the next thing that I would say to them is for that credit card, like they have to gain momentum. They have to get laser focused on paying off that credit card, because once they knock that out, then they're going to go through the debt snowball. So they're going to be able to then take that money and start paying off the next debt with it. But they have to get laser focused, start selling things in their house, sell stuff on eBay, raise as much money as you can, watch where you're spending your money, stop everything until you pay off that credit card and really get this thing going. Now, jumping back over to the net worth statement, looking at the assets, there's really nothing here that they could use to throw at that credit card. So the $4,000 that they have in the savings account, I'd probably just tell them to leave that instead of taking it and paying it towards the credit card. I mean, they could, if they wanted to, take that $4,000 and throw it at the credit card and then try to build that savings account up again once they pay that credit card off. But I'd probably just tell them to leave it. Then for like the 529 plan, you're not touching that money, but we'd stop contributing to it. For the Roth IRA, technically they could withdraw some money from the Roth IRA if they needed to pay down that credit card with it, but I would not advise them to do that in this situation. Maybe if that credit card, was $40,000, $50,000, $60,000, somewhere along those lines, I would make that recommendation. But in this situation, leave the Roth IRA. The 401k plans, we're leaving those. Some positives when looking at this, I mean, they've saved $230,000 in retirement accounts. So that's a pretty good number, for their age. So just to sum this up, if these were my clients and I was sitting down with them, number one recommendation would be focus on getting out of debt. That has to be the number one goal here. Start with the credit card, attack it with laser focus, go after it, get rid of it. Do not use that card anymore. Put it in a drawer and just attack it. Once you get rid of that card, then start going after the student loan. Go after the $30,000 balance student loan. It's going to take you some time, but you have to attack that. Then go after the next student loan. Once you get out of the student loan debts, those cars, get out of the leases, finance cars that are going to be much lower in cost, and then attack those loans. Get rid of those loans, and now you got to start going after that home equity line of credit. Get rid of the home equity line of credit, and the only debt that you should have remaining is going to be your mortgage. And now when you're in that position, you are in a very strong financial position. Now you could start directing that excess money into all different types of investments. You could start plowing money into the kids' 529 plan, build up that emergency fund, max out the 401ks, save money in just a traditional brokerage account, a non-retirement account that you could access, maybe 10 years from now, or for those middle ages in between now and when you do retire. Start plowing money into different places. And hopefully your income will also go up. So as your income goes up and you're knocking out these debts, the gap grows wider between your income and your expenses and the more money that you could save. So that would be my recommendation for them. Focus on the debt. That's it. You get rid of all this debt, life is going to get better for you. So this is just one step in creating a financial plan for somebody, but it's a very important step and it's eye-opening, and it just shows you kind of where you stand with everything, where you are and what you need to focus on going forward to ultimately, achieve financial freedom and reach your goals. All right, everybody, that's it for this one. Please hit that like button if you enjoyed this video. Subscribe to the channel if you've not done so already, and I will see you again next week. Thanks a lot.